Here are the different accounts that we'll see, the equity accounts: capital stock, also known as common stock, APIC, and retained earnings. Just kind of a nice intro here. Capital stock, this is always at par value, which you could think of as kind of like the IPO price or the listing price or the creation price. APIC, this is the internally generated sort of gain tracker for a company. And this is something no one really ever explained to me enough in school, or even when I was taking the exam. This is something I want to really clarify for everyone. Like, what is APIC? What is par value? What is all of that? And retained earnings, the big takeaway here is that net income increases it, dividends decrease it. All right, let's see this right here. Well, we've got equity. Equity can be broken up into retained earnings and contributed capital. Why is this earned capital? Well, like I said, net income increases retained earnings. It's like the bank account for your net income. It's where you keep it. And you pay it out as dividends. I mean, you don't have to pay it out as dividends, but it's restricted. If you're going to pay it out as dividends, then you have an unrestricted portion. You can also use this for anything, right? Anything in your company. This is just cash you can use for anything. Contributed capital, these are going to be people buying into your stock, right? Giving you money, contributing to the overall business. Now, what I've got here, generally your par value is going to be a nice clean number. It's going to be $1 par value stock, $10 par value. And this is going to be, again, like you hammer out the stock, you create it, you IPO it, you list it. Just think of this as the original value of the stock. So on the balance sheet, you'll usually see common stock, like 1,000 shares at $10 par value. So that's going to be, just $10,000 of common stock. Now, that's going to stay in that small amount, but as this value of the stock increases, you're going to have an APIC balance. And that is going to account for the difference between the fair value of the stock and the par value of the stock. That's what we'll see there. Just want to cover a little bit of retained earnings as well. Think about our journal entries. So when we pay out dividends, we debit retained earnings. And remember, in our equity accounts, how do you decrease an equity account? You debit it, and increase, you credit it. So if you're paying out a $10,000 dividend, well, technically this is the journal entry because you're reducing cash, you're paying out cash. But you could also break it out: retained earnings, 10,000, and then dividends payable for 10,000. If you're not paying it out right away, and then dividend payable for 10,000, and then cash for 10,000. That's if you're paying it out. Obviously you're probably not paying it out the day you declare it. This is on the date of declaration. This is when you actually pay out the dividend, right? That is the journal entry. That's how that works. Now, what about, like I said, so dividends reduce, and I'm going to say this over and over, right? I'm going to beat it to death. Now, dividends decrease your retained earnings. Now, net income increases your retained earnings, right? Net income increases your retained earnings. Well, we need to adjust that, right? So we earn income. We are going to have a journal entry for that as well. This is one that is not as common, right? It's not going to be really common. If you just think about it right here, well, we have this income summary. What happens is at the end of the year, revenue minus expenses equals net income. We have this account called the income summary. Now, this is not for, you're not going to have questions on this, but I think this is super important to understand the underlying concept as a whole, which you'll have questions about. Now, what you're going to do, let's say you made $10,000 of net income. Just revenue minus expenses gives you $10,000 in net income. And what you're going to do is you are going to, income summary is a debit for $10,000, and you're going to credit retained earnings. Retained earnings for $10,000. That's how you increase your retained earnings. This is something I wish someone would have told me. Actually, let's assign more numbers to this. Let's say this is $35,000 of revenue and expenses are $25,000. Because you got to remove revenue and expenses and all the income statement items off of your accounts for the year at the end of the year. So what are you going to do? Well, to increase revenues, you credit them, decrease them, you debit them. So revenue for 35, because it was credited throughout the period for 35, right? So then that's going to be income summary for 35, and then income summary for 25, and then expenses for 25. And you see the net effect So the balance of the income summary account right now is 10,000. Here is it. It's getting eliminated, and that 10,000. This is the process at the end of the year. If you're ever curious, how your when I say net income increases retained earnings, this is how it actually does that. So this is the whole process. Again, something that you probably haven't seen before or anywhere else. I hadn't until I really dug into it, but something I like to just display for everyone.